By 11:47 a.m., the damage was undeniable. That is the version of events the mainstream wants you to accept. Strong economy crushes safe haven demand. Move along. Except I was watching the order flow. This was not retail panic. This was institutional coordination with a very specific catalyst, and that catalyst appeared at 9:14 a.m., a Bloomberg terminal alert. 13 words. Sources say Russia considering partial reversal of dollar ban for select energy trades. 13 words erase 10% of silver's value in 90 minutes. Now think carefully about what just happened. The entire precious metals bull market since 2022 has been built on one foundational reality. The United States weaponized the dollar through sanctions. Russia stopped accepting dollars for energy in April 2022. China started settling oil in yuan. Saudi Arabia let the petrodollar agreement expire. The BRICS nations launched a partial gold-backed settlement system in October 2024. Every single one of those developments removed support for dollar dominance and pushed capital into tangible assets. Gold went from $1,900 to $3,400. Silver went from $24 to $84. Those are not normal bull markets. Those are monetary crisis valuations. But if Russia reverses course, if Putin says we will take dollars again for energy exports to Europe, that psychological anchor breaks. The narrative shifts. Maybe the dollar survives. Maybe de-dollarization was exaggerated. Maybe you do not need physical metal because the system is not actually collapsing. That is what the algorithms calculated at 9:14 a.m. And when high-frequency trading systems that control 73% of COMEX futures volume scan Bloomberg, Reuters, and the Wall Street Journal for keywords like Russia plus dollar plus reversal, they execute in microseconds. 47,000 contracts sold in the first 15 minutes. That is 235 million ounces of paper silver dumped before most human traders even finished reading the headline. Let me put that number in perspective. Global silver mining output for 2025 was approximately 830 million ounces. In 15 minutes, the paper market traded the equivalent of 28% of annual worldwide production, not physical bars moving between vaults, derivative contracts, synthetic exposure, numbers on screens. But those numbers determine the spot price that every dealer on earth uses to set premiums. So when you walk into a coin shop today and the dealer quotes you $82 for a silver eagle, that price is anchored to a $76 spot that was set by an algorithm responding to an anonymous rumor about Russian energy policy. That is the crime scene. Price discovery is completely divorced from physical supply and demand, and that disconnection is not accidental. Because if spot prices actually reflected industrial consumption, solar panel demand alone would push silver north of $150. Instead, we have a fractional reserve paper system designed to suppress valuation while insiders accumulate real metal at artificial discounts. Let me give you 3 historical examples of this exact playbook. Write these down. Verify every claim independently. March 2008. Bear Stearns is imploding. Stock price collapsing from $93 to $2 in a single week. Gold surges to $130 on March 17th because traders understand this is systemic failure. Then the Federal Reserve announces coordinated central bank intervention. A rumor circulates that the Fed will backstop all major investment banks. Gold drops $80 in 72 hours. The narrative was crisis contained. 6 months later, Lehman Brothers collapsed and gold rallied to $1,900 by 2011. That 3-day drop in March 2008 was narrative management, intentional messaging deployed to shake weak hands before the real move. September 2011, silver at $43 after rallying from $18 in 2010. The narrative was dollar collapse, quantitative easing destroying currency values, physical shortages at the U.S. Mint. On September 22, 2011, the CME raised margin requirements on silver futures for the 5th time in 8 days, from $9,000 per contract to $21,600. Forced liquidation. Silver crashed from $43 to $26 in 3 weeks, a 40% destruction. The stated reason was reducing speculation and ensuring market stability. The actual effect was targeted suppression of a parabolic rally that threatened paper market solvency. March 2020, COVID lockdowns begin. Physical silver goes into backwardation. You literally cannot purchase coins or bars at any price in the United States. Dealers sold out. The U.S. Mint suspends eagle production. And yet the spot price drops from $18 to $12. How does silver become cheaper when physical supply is completely unavailable? Because COMEX paper contracts were liquidating to raise cash for equity margin calls. Hedge funds needed dollars immediately. They sold everything they had. Futures crashed, spot price followed, physical premiums exploded to $10 over spot while paper said $12. 3 historical examples, 3 identical patterns. When genuine systemic stress builds, coordinated narratives create temporary price drops that shake retail investors and allow well-positioned buyers to accumulate at suppressed levels. The Bear Stearns intervention bought 3 days. The CME margin hike bought 3 weeks. The COVID crash bought 6 weeks before physical premiums forced reality back into pricing. Yesterday, we got the Russia rumor. The question is whether this shakeout lasts 6 hours, 6 days, or 6 weeks. To answer that, we need to examine the sourcing. Bloomberg said sources familiar with the matter, anonymous, not a Kremlin press release, not Putin standing at a podium making official policy announcements. Sources. In journalism, that phrase can mean a junior staffer at the Russian finance ministry repeating hallway gossip. It can mean a Western intelligence asset planting disinformation. It can mean a commodities trader with short positions who called a media contact with strategic misinformation to profit from the resulting price movement. I went back and reviewed actual Russian government statements from the past 6 months. December 2025, Putin at the BRICS summit in Kazan. The era of dollar dominance is ending. We will construct a multipolar currency system. January 15, 2026, Russian Finance Minister Silvanov. All energy exports to non-friendly nations will be settled in rubles, yuan, or gold. This policy is irreversible. February 3rd, 2026, 10 days ago, the Russian central bank announced they are increasing gold reserves by another 200 tons this year. Do those statements sound like a government preparing to reverse course and resume dollar acceptance? Or do they sound like the precise opposite? Here is my analysis. Watch the next 72 hours to see whether the evidence supports it. I believe a coordinated effort involving major bullion banks holding significant short silver positions was behind this rumor, timed specifically to engineer a sell-off before the weekend. Why before the weekend? 2 full days of no trading, 2 days for the narrative to circulate among casual investors who read headlines without analyzing the underlying mechanics, 2 days for less informed holders to contact their brokers Monday morning and liquidate SLV shares. While that panic unfolds, what are the best positioned players doing? Buying physical at $76, covering short positions at a 10% discount, accumulating inventory before the rumor gets officially denied and price gaps back to $83. Let me show you the technical configuration that makes this timing even more deliberate. Silver was approaching major resistance at $85. That level generated massive selling pressure in November 2025. Every attempt to break $85 got rejected. We had been consolidating between $78 and $84 for 2 months. That is a classic bull flag pattern, a textbook continuation setup. Continuation patterns resolve in the direction of the prior trend, which was upward. If you are a bullion bank short 200 million ounces of paper watching price coil tighter below resistance, what is your move? You cannot allow a breakout above $85 because that triggers momentum algorithms and retail buying pressure. Suddenly you face a situation where you are forced to cover shorts at $95, $105, $120. You need to destroy the pattern. You need downside volatility that kills the bullish structure and terrifies momentum traders, so you plant a rumor. 13 words. Russia considering partial reversal of dollar ban for select energy trades. Algorithms execute the rest. 47,000 contracts in 15 minutes, price drops 10%, bull flag annihilated, weak hands eliminated, mission accomplished. Now here is where it becomes even more revealing. While silver dropped 10%, I was monitoring US Treasury markets simultaneously. The 10-year yield barely moved from 4.23% to 4.26%. 3 basis points. If markets genuinely believed the jobs report was strong, the economy was resilient, and the Federal Reserve would hold rates higher for longer, you would expect a much larger move in yields. The 10-year should spike to 4.35%, 4.4%, because a strong economy implies higher inflation risk, which demands higher yield from bond investors. But yields did not move. The dollar index went from 107.2 to 107.8, 0.5%, modest. Not the surge you would expect if markets concluded de-dollarization was dead and dollar hegemony was restored. Equity markets, the S&P 500 up 0.3%, NASDAQ up 0.4%. Barely noticeable. These are not the reactions of a market receiving confirmation that the global financial system is stable and the dollar is secure. The only asset class that moved violently was precious metals. Gold down 3.2%, silver down 10%, platinum down 4.1%. Mining stocks, the GDX Gold Miner ETF, down 6.8%. Why would mining stocks drop harder than the metal itself if this move was genuinely about fundamental economic strength? Mining stocks are leveraged to metal prices, yes, but they are also industrial companies with real earnings and dividends. Strong economies should support mining equities even if metal dips slightly, unless the move was not about economics at all, unless it was a targeted strike on a specific sector using a specific narrative weapon. Surgical, precise, isolated to metals while broader markets barely reacted. Now let me dismantle the jobs report itself because that is the official explanation being offered. 130,000 jobs added in January. The headline looks solid until you examine the composition. 89,000 of those jobs were in healthcare and social assistance, government-adjacent employment, hospitals, nursing homes, home health aides. Much of this is Medicare and Medicaid funded, meaning taxpayer-supported. Another 23,000 jobs came from leisure and hospitality, restaurants, hotels, bars, low-wage, high-turnover positions. Out of 130,000 jobs added, 112,000 were in healthcare and hospitality. That leaves 18,000 jobs across the entire rest of the economy. Manufacturing added 4,000, essentially a rounding error. Construction lost 7,000 jobs. Retail lost 11,000. Professional and business services added 12,000, but that category includes temp agencies, which does not signal robust full-time employment demand. This is not a strong jobs report. This is mediocre data being presented as strong, because the messaging environment requires positive framing, and the Federal Reserve needs justification to hold rates at 4.75% instead of cutting. The composition reveals an economy where people are taking healthcare aid jobs and restaurant positions because they cannot find employment in higher wage sectors. Here's the detail that should concern every serious analyst. The household survey used to calculate the unemployment rate showed a decline of 31,000 employed people in January. The establishment survey said plus 130,000. The household survey said negative 31,000. That is a 161,000 discrepancy. The establishment survey is used for the headline number because it looks better. The household survey is actually more accurate for capturing gig economy work and self-employment, and it shows contraction. And even accepting the headline number at full face value, 1 month of decent employment data does not change the trajectory of an economy carrying $36.2 trillion in federal debt, running a $2.1 trillion annual deficit, facing $175 billion in monthly interest payments. The mathematics do not work. One jobs report does not fix structural insolvency, but it provided cover for the real trigger, which was the Russia rumor. Mainstream financial media could report that silver dropped on strong jobs data, and viewers without deeper context nod and think that makes sense. Strong economy means less safe haven demand. Meanwhile, anyone watching the actual order flow saw the timestamp. They saw the Bloomberg headline at 9:14 a.m. They saw the volume signatures. They understood what was happening. Let me walk you through the order book dynamics, because this is where the institutional fingerprints become visible. When silver futures started dropping, the first sell orders were large blocks, 500 contracts, 1,000 contracts. Not retail traders panic selling 5 contract positions, institutions, and they were not just selling at market price. They layered sell orders below the bid, intentionally creating the visual appearance of overwhelming sell pressure to trigger stop-loss orders and momentum algorithms. At 9:28 a.m., spot silver was at 82.10. Sell orders stacked at 82.50, 82, 81.95, 81.90 all the way down. That is called painting the tape. You manufacture the visual appearance of overwhelming sell pressure to trigger automated systems. It worked. At 9:30 a.m., silver broke below $82. That triggered stops, more selling. Price drops to $81.50. More stops triggered more selling. By 9:45 a.m., $79. By 10:15 a.m., $76. This is a liquidity cascade, a mechanical flush where each support level breaks and the break triggers more selling, and the selling breaks the next support. An extremely profitable feedback loop if you initiated the cascade because you can cover short positions at progressively lower prices, then flip long at the bottom and ride the recovery. Here's how you confirm orchestration rather than organic panic. At 10:43 a.m., after silver hit its 75.80 low, the selling stopped immediately, not gradually, not tapering off, like a faucet turning off. At 10:44 a.m., large buy orders started appearing. 800 contracts at 76.20, 200 contracts at 76.50. By 11 a.m., silver had recovered to 78. That is not organic market behavior. Organic sell-offs do not have clean bottoms. They are messy, with back-and-forth retests of lows, uncertainty, indecision. This was controlled demolition followed by equally controlled accumulation. Someone sold price down to 75 or 80 and immediately started buying it back. That someone has substantially more capital and substantially more information than most participants in this market. Who benefits? Follow the money. The 4 largest bullion banks on COMEX are JP Morgan, HSBC, Scotiabank, and UBS. These institutions collectively hold short positions equivalent to 380 million ounces of silver, 46% of annual global production. They are structurally short. Their business model involves selling paper exposure to investors and hedging with minimal physical inventory. As long as price stays suppressed, they profit. If price breaks out and runs to $120, they face billions in losses. They have a direct financial interest in preventing breakouts. They have the tools to create volatility that discourages retail participation. Direct access to COMEX trading systems, relationships with media outlets, algorithmic trading systems executing complex strategies in milliseconds, and critically, they operate in a regulatory environment that has historically treated precious metals manipulation as a manageable cost of doing business. This is not speculation. In September 2020, JP Morgan was fined $920 million for spoofing precious metals markets. Spoofing is placing large orders to create the appearance of demand or supply, then canceling before execution. Pure market manipulation. JP Morgan did this thousands of times between 2008 and 2016. The Department of Justice press release from that case stated explicitly that JP Morgan traders placed orders to buy and sell precious metals futures contracts with intent to cancel those orders before execution in order to inject false information into the market. False information. That is the government's own language, not an allegation. A documented finding. The government admitted that major banks were injecting false information into precious metals markets. You think they stopped in 2016? That a $920 million fine fundamentally changed the business model? What changed is the sophistication. Instead of obvious spoofing patterns, the approach evolved toward narrative deployment, coordinated headline timing, algorithmic trading strategies that are technically legal but achieve identical market-moving effects. That is what we witnessed yesterday, a narrative weapon deployed at a specific time to achieve a specific price target. The jobs report was cover. The Russia rumor was the payload. The algorithm-driven sell-off was the delivery mechanism. The result was a 10% drop, allowing shorts to cover and patient buyers to accumulate. Now let me address what happens next because the narrative has been deployed and the damage is done. The question is whether this rumor has durability or gets officially denied within 48 hours. If Russia releases a statement saying they have no plans to accept dollars for energy exports, silver could gap up Monday morning and open around $82 to $83. The entire drop erased. People who sold physical at $76 watch price recover and realize they handed metal to dealers for 10% less than its value 24 hours earlier. If Russia stays silent, neither confirming nor denying, uncertainty lingers. The market trades on speculation. Continued consolidation between $76 and $80 while traders await clarity. That scenario actually offers physical buyers maximum opportunity because premiums stay elevated while spot remains depressed. If Russia actually confirms, if there is an official announcement that they are accepting dollars again for specific trade deals, that is a genuine shift in the de-dollarization narrative, and it supports a move back towards $70 or even $65 near term. But even that does not change the long-term thesis. Even if Russia accepts dollars for some trades, China is not. Saudi Arabia is not. The BRICS payment system is still under construction. Central banks are still buying gold at record rates. The Bank of China added 18 tons of gold in January 2026 on top of 225 tons added in 2025. The Central Bank of India added 12 tons in January. Poland added 11 tons. These are official reported purchases. Actual buying is likely higher because central banks purchase through intermediaries to avoid moving markets. This is documented. The World Gold Council publishes quarterly data on all of it. Even if de-dollarization slows or pauses in one specific area, the macro trend still points toward currency diversification and hard asset accumulation by sovereign actors, and that supports higher gold prices over any meaningful time horizon. And silver follows gold, always, usually with 3-to-1 leverage on the move. Here's the strategic framework given what we know. If you believe the rumor is false or substantially overstated, this is a 10% discount on an asset in bullish consolidation before a manufactured sell-off. Physical, not paper, no leverage, no ETF that can be diluted or manipulated, coins or bars from reputable dealers held directly. If you believe the rumor has genuine substance and de-dollarization is actually reversing, you wait. You let silver find its floor wherever that turns out to be. You watch for stabilization and reassess the thesis with fresh data. But understand one thing clearly either way. If you sell your physical stack right now based on 13 words from an anonymous Bloomberg source, you are doing exactly what the most sophisticated actors in this market want you to do. You are giving them metal at a discount. Let me show you what actual physical demand looks like right now, because this is where the paper narrative completely falls apart. The U.S. Mint sold 1.4 million Silver Eagles in January 2026, the highest January on record. The Royal Canadian Mint reported silver maple sales up 38% year over year. The Perth Mint in Australia has a 6-week backlog on silver orders. If demand for physical silver is at all-time highs, why is the price dropping? Because the price is not set by physical transactions. It is set by paper contracts on COMEX, and paper can be created in unlimited quantities to suppress price regardless of what the physical market is doing. Here is the specific mechanical breakdown of how this operates. Right now, COMEX registered silver inventories sit at 46.2 million ounces. That is the physical metal actually available for delivery against futures contracts. But open interest in silver futures is 184,000 contracts. Each contract represents 5,000 ounces. Total open interest is 920 million ounces. Paper claims on silver are 20 times higher than available physical inventory. What happens if even 10% of contract holders demand physical delivery? 92 million ounces requested, only 46 million available. The exchange cannot deliver. It settles in cash. It pays dollars instead of metal. And that cash settlement occurs at whatever the manipulated spot price happens to be in that moment, not the real premium adjusted physical price that dealers are charging. Fractional reserve for metal, identical concept to fractional reserve banking. The bank does not have all deposits on hand. It counts on the fact that not everyone withdraws simultaneously. COMEX does not have all the silver its contracts represent. It counts on the fact that most futures traders are speculators seeking price exposure, not entities that actually want physical delivery. But if that assumption breaks, if physical delivery demands surge, the system faces a stress scenario it was never designed to handle. We are already seeing early stress signals. December 2025, COMEX silver deliveries hit 14.8 million ounces, the second highest month on record. Someone is taking delivery at scale. Someone is systematically draining physical from the exchange. The more metal leaves, the more precarious that 20-to-1 ratio becomes. This is precisely why sustained price suppression is operationally necessary for the current system. If silver runs to $120, industrial users start panicking. Solar panel manufacturers, electronics producers, medical device companies, they demand physical delivery to secure their supply chains. Investors pile in on momentum. Delivery demands spike. Inventories drain faster. And the exchange faces a force majeure scenario where physical delivery becomes impossible. COMEX Rulebook, Section 15.01. In the event that physical delivery becomes impossible or impracticable, the exchange may settle contracts in cash at the prevailing market price. Translation: if they run out of metal, they pay dollars and move on. Those dollars worth less every year due to ongoing monetary expansion. The game is keep price suppressed, keep the narrative uncertain, keep retail investors scared and reactive while entities that understand the endgame accumulate physical quietly at artificial discounts. Banks can manipulate paper price indefinitely. They cannot print physical silver. Right now, the physical market is sending a signal that should not be ignored. Golden State Mint, one of the largest private mints in America, shut down silver sales for an entire weekend. Their statement was direct. They were not able to secure silver. One of the biggest mints in the country could not source metal and had to stop selling entirely. The last time this happened was March 2020. When the entire global economy was on the edge of a financial collapse, COVID lockdowns were beginning, and people were panic buying everything with a tangible value. That is the only other recent instance where a major mint shut down sales because they could not find metal to sell. And it just happened again this weekend, immediately following yesterday's crash. Think carefully about what that implies. The paper price says silver is worth 76.6, but the physical market is so tight, so stressed, so completely disconnected from the paper price that one of the largest mints in America cannot buy silver to sell to its own customers. If real silver was genuinely available at $76, do you think Golden State Mint would have shut down and turned away business? They would have bought every ounce they could find and sold it at a premium, but they could not find it because it does not exist at these prices. The paper market and the physical market have not just diverged, they have broken apart. The paper price is a number generated by algorithms responding to anonymous rumors. The physical price is what dealers are actually charging because that is what securing real metal actually costs. The gap between them is not just wide, it is structurally broken. Yesterday did not just move the price. Yesterday shattered something in the physical silver market that was already under significant strain. And I believe the recovery, when it comes, will be fast and disorderly. The same algorithms that drove price down will drive it up. The same leverage that wiped people out on the way down creates enormous gains on the way up. And the physical shortage only deepens with each episode like this because every manufactured crash drives more people to buy physical and take actual delivery, removing silver from the paper system entirely and making the fractional reserve ratio even more precarious. There is something larger building here as well. Remember that while silver crashed 10% yesterday, the U.S. Treasury market barely moved, 3 basis points on the 10-year yield. If markets truly believed the jobs data confirmed a strong, resilient economy, and the Russia rumor confirmed dollar hegemony was intact, the yield move should have been 10 times larger, the dollar index moved 0.5%, equity markets moved less than 0.5%. These are not the reactions of a market receiving genuinely positive systemic news. The only assets that moved violently were precious metals, that isolation, that surgical precision in which sector took the damage while everything else was left essentially untouched. That tells you this was a targeted intervention in a specific market for specific reasons. And the physical market breaking simultaneously tells you the underlying stress is real regardless of what any paper price says. When a major mint cannot source silver after a paper price crash, when premiums at dealers are 50% to 100% over spot, when the largest futures exchange in the world has 20 paper claims for every physical ounce it holds, you are not watching normal market volatility. You are watching a system operating under extreme and increasing stress. The patterns that preceded major dislocations in 2008 and 2020 had these same characteristics. Stress appearing in strange places, disconnects between paper and physical, narratives deployed with suspicious precision at suspicious times. Every one of those episodes resolved with a violent repricing of physical assets that left sellers at the bottom with permanent losses and buyers at the bottom with generational gains. Bloomberg said sources familiar with the matter, anonymous, not an official Russian government statement, not Putin at a podium. I reviewed actual Kremlin statements from the past 6 months. Every single one says de-dollarization is irreversible, the multipolar currency system is under active construction, gold reserve accumulation is accelerating, physical demand is at all-time highs. The U.S. Mint is selling record silver eagles. The Canadian Mint is up 38% year over year. The Perth Mint has a 6-week backlog. Golden State Mint shut down this weekend because they could not source metal. The last time that happened was during COVID. The physical market is breaking in real time. The paper price has disconnected from physical reality. The bullion banks with massive short positions covered at the exact bottom. Mining stocks barely moved because informed participants know this move was manufactured. March 2008, September 2011, March 2020. 3 times we have seen this exact playbook executed. A narrative is deployed, price crashes, less informed holders are shaken out, recovery follows, same pattern, different decade, same mechanisms, same beneficiaries. This is not a free market operating normally. This is a documented, fined, and openly acknowledged system of market management that continues because the profit from doing it exceeds any regulatory consequence for getting caught. The question is not whether this is happening. The documented history of JP Morgan's $920 million fine and the DOJ's own language about injecting false information into markets confirms that it happens. The question is simply what you do with that information and how you position yourself accordingly. The paper price is a number. The physical market is reality. Right now, those two things are saying completely different things. History is consistent about which one wins.